Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our Q&A webinar. I'm going to be giving you some basic information, and then we're going to answer your questions. So to get started, I do need to tell you a bit about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. We don't represent or sell securities or investments of any kind. We're not a registered investment advisor, and we don't endorse or represent any particular investment opportunities that I may talk about during this presentation. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. In this evening's webinar, I am going to give some basic information about self-directed retirement accounts and some investment options that are available to you. I'm going to talk about guidelines that relate to self-directed retirement accounts, the structure that STC uses for each of our clients' account, an LLC structure, the services that we offer, and then I'll get to your questions and we'll try to get all of those answered. So just to get started, I do want to talk a little bit about what is a self-directed retirement plan. When we use that terminology, what we mean is you, as the retirement account owner, may choose any type of asset that is permitted by law. And that means that you can include things that are considered non-traditional assets by some, like real estate. It also means that you manage your retirement plan's investments. You're going to make the decisions that relate to those investments. So basically, you have control. If, for example, you chose to purchase a piece of real estate in your retirement account, you would be the one who would decide if you wanted to rent that property, what the rental rate would be. You could choose renters. You would decide if you were going to fix up the property. So basically, you're making the decisions that relate to the investments in your retirement plan. Now, there are a number of different types of retirement plans that can be self-directed. The first two that I'll bring out onto your screen are traditional IRA and Roth IRA. These are similar in that they have the same maximum annual contribution allowances. So for 2022, that number is $6,000 from your earned income, or if you're 50 years or older, $7,000 from your earned income can be contributed into each of these plans. Now, the difference is that monies that go into a traditional IRA, like most retirement plan contributions, are pre-tax. You don't pay tax on those contributions, but when you begin taking qualified distributions, once you reach retirement, Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our Q&A webinar. Before I get started, I do want to tell you just a bit about STC. We are a retirement plan administrator only, and we do not provide legal, tax, or investment advice. We also don't represent or sell securities or investments of any kind. We're not a registered investment advisor, and we don't represent or endorse any investment opportunities that I might talk about during this presentation. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. Now, this evening's webinar is going to include a discussion of self-directed retirement accounts, investment options that are available to you, some guidelines that do need to be followed in retirement account investing, the structure that STC uses for each of our clients' accounts, and our services. And then I will open up the floor for your questions and we will get those answered. So to get started, I do want to define what we mean when we use the terminology self-directed retirement plan. It means that you're holding your account with a company that permits you to choose any asset that is allowed by law. So anything that is permitted by the IRS regulations, the ERISA regulations. So that would include things that some consider non-traditional assets like real estate. Self-direction also means that you are going to manage your retirement plan's investments. You're going to make the decisions related to those investments, and you will have control over those decisions. So, for example, if you decided that you wanted to purchase a piece of real estate and own that in your retirement account, you would determine if you wanted to make that a rental property. You would decide the rental rate. You would determine if you wanted to upgrade the appliances, or if you needed to put a new roof on, you would hire a roofing company. So you would make those decisions that related to the investments in your account. Now, there are a number of different types of retirement plans that can be self-directed. The first two that I'll bring out onto your screen are both IRAs, a traditional IRA and a Roth IRA. They are similar in that their annual contribution limits are identical. In 2022, you can contribute $6,000 of your earned income into a traditional or a Roth IRA. If you're 50 years or older, you can increase that by $1,000 to a $7,000 contribution. The difference between these two accounts is that contributions to a traditional IRA, like most retirement account contributions, are pre-tax. In other words, you don't pay taxes on the amount that you contribute to the account. Rather, when you reach retirement age and you begin taking qualified distributions from the account, that's when those distributions are included in your taxable income. A Roth IRA is different. Your contributions are taxed, so they are post-tax contributions. However, when you take qualified distributions from a Roth account, when you reach retirement age, those distributions are not included in your taxable income. So that means that all of the earnings on your Roth contributions have basically been earned tax-free if they meet those qualified distribution requirements. So that is a distinct difference between Roth contributions and other types of retirement plan contributions. A SEP plan is a simplified employee pension plan. I have seen some sole proprietors or small business owners have this type of plan. It does permit you to make both an employer and an employee contribution, and it permits you to make larger contributions. So for 2022, a SEP contribution is $61,000 is the maximum. A simple plan, a savings incentive match plan, another type of plan that you might want to look into. I know some sole proprietors, some partnerships use this type of a plan. It permits a $14,000 annual contribution with a catch-up contribution if you're 50 years or older of $3,650. So you can make some larger contributions if you are 50 years or older. Now, I've brought out onto your screen now 4 different plans that all say former employer. A 401k is a for-profit corporate type of plan. A 403b is a charitable or sometimes nonprofits use this type of plan. TSA, tax sheltered annuity, TSP, thrift savings plan. If you formerly worked for an employer and participated in one of these types of plans, then you can move those monies, roll them over into a plan that you qualify for, and working with a self-directed company, you can self-direct those monies. Now, if you are currently employed and participating in one of these plans, then you will need to go to your employer and the plan administrator and ask if there are monies in your portion that you can move to a plan that you can self-direct. So you will need to check with your plan administrator if you are currently employed. Now, a solo 401k is a newer plan, although it's been around for quite some time now. It is a plan that was designed for sole proprietors, for people who are in business for themselves, by themselves, pretty much. You really can have very limited employees. You could have a spouse working with you in the business, but it does permit you some opportunities to make larger contributions and from the business that the plan is on. So if you have your own business and you're interested in a solo 401k, you could actually contribute for 2022 up to a maximum of $61,000 from that corporate earnings, and you could increase that by $6,500 if you are 50 years or older. So it does give you an opportunity, if you're a business owner, a sole proprietor, to kind of have some of the same benefits that 401k corporate employers have. Some nice features of a solo 401k are that there is a Roth provision available if you design that into the plan documents when you set up the plan. So that means a portion of the contributions can be designated as Roth contributions, post-tax, but then earning tax-free. And you also have the possibility of a loan provision with a solo 401k. And the interesting thing about that loan provision is those monies can be used for any purpose. They don't necessarily have to be for the business's welfare or benefit. As long as those monies are paid back in the time frame and with the interest that is laid out in the plan documents, you can use those monies for anything. So a loan provision, a Roth provision, those are available to a sole proprietor with a solo 401k. If you are interested in that type of a plan, please do let me know and I can get you some more details on that information. Now, with a self-directed plan, you do have a wide variety of investment options available to you, anything that's permitted by law. So there are a large number of real estate types of transactions that you can engage in. You can certainly invest in single or multifamily homes, vacation investment property, tax liens. Now, let me just say here, tax liens, you're actually not investing in the real estate. You're actually investing in a lien on the real estate. What happens with a tax lien is if for some reason the person does not repay the lien, then it is a foreclosable lien. So you could potentially own that property if the lien wasn't paid back. If you're interested in tax liens, I do have a previously recorded webinar on our website that might be of interest to you. I do want to back up just a moment because I mentioned vacation investment property and kind of glossed over it. I do want to make one statement about vacation investment property. If your retirement plan, say, purchases something, a rental property at the beach, you cannot personally use that vacation property. That would violate some of the rules that relate to retirement accounts. So it does need to be an investment property. You can rent it to unrelated persons, but it does need to be an investment property, not something that you personally use. You can also invest in raw land, building lots, commercial buildings. I have talked with a number of folks who have gone into commercial building syndications, so they may not have enough money in their retirement account to participate and wholly own a commercial building, but they can be a part of a syndication, real estate syndications. You can also loan money from your retirement account. You can use a promissory note. You can have collateral. You can set the terms, the interest rate. You can also purchase mortgages, so you have real estate-backed mortgages. You can invest in private businesses. Certain precious metals, those are defined by law. If you're interested in those, I can give you some more details on precious metal investing in a retirement account. You can also invest in the Forex market, foreign currency, options, futures, and of course, you could certainly have a portion of your self-directed retirement account in stocks or bonds or mutual funds. So all of these investments are available to you when you have a self-directed account. Now, I do want to talk with you about some of the guidelines. We don't expect our clients to be experts, but we do want to give you some general information. So when you're thinking about initial investments, you'll have some things in mind that you know you can do or can't do. But we are happy to help you with discerning what those things are in detail as a client. So there are some investments that are prohibited. You may not invest in them in a retirement account, one being a life insurance contract. Now, there is an exception to this. If your plan is a solo 401k plan, then life insurance contracts are permissible, but in other types of plans, they are not. Another prohibited asset type is collectibles, rugs, works of art, stamps, coin collections. Those are not permitted as retirement account investments. There are also certain types of transactions that are prohibited. Keep in mind that your retirement account is given tax preferential treatment because it is meant to benefit you personally when you reach retirement age. So you must engage in transactions that are for the exclusive benefit of the plan. You're not permitted to engage in transactions that might benefit another party and not your plan. You cannot personally borrow money from your retirement plan. You cannot pledge your plan assets to secure a personal loan. Now, I have seen some loan documents that request information about your retirement plan, and that's okay. They just cannot be security or collateral for that personal loan. You also cannot utilize your personal credit or guarantee to obtain a loan for your retirement plan. So let me just expound on this a little bit. If you wanted to purchase real estate in your retirement account, but you had insufficient funds to wholly purchase the property, your retirement account can get a loan to purchase that property, but it must be a non-recourse loan. It cannot be a personally guaranteed loan. So you can use a loan, but it must be a non-recourse loan. And if you're interested in details about that, please do let me know by submitting a question in the question box. And I do also have another webinar that we talk a fair bit about what a non-recourse loan is. So you can use a loan, it just cannot be a personally guaranteed loan in your retirement account. You also cannot benefit any disqualified person with a transaction that your retirement account engages in. So let's take a look at who disqualified persons are. And you'll see the first person is you. You and your retirement account are distinct entities. So if you personally owned a vacation rental property at the beach, your retirement account cannot purchase it from you. That would violate the disqualified person rule. And if you are married, your spouse is also a disqualified person. There are other family members who are also disqualified, ascendants, so that would be your parents, your grandparents, your great-grandparents. Your descendants, your children, your grandchildren, your great-grandchildren, on down the line, are all disqualified persons. However, lateral family members are not disqualified. So let me just explain this a little bit more. If your father owned that vacation property, your retirement account could not purchase it from him. If your daughter owned it, your retirement account could not purchase it from her. However, if your brother or your aunt or your cousin owned it, they are considered lateral family members, and your retirement account could do a direct transaction with them. So it's kind of interesting to think about who you can and cannot engage in a transaction with directly. There are two other entities who are disqualified persons to your retirement account. The first is any company, doesn't matter how it's organized, LLC, S Corp, whatever, any company, if you are a majority shareholder, is a disqualified person to your retirement account. Also, any company if you're an officer, a director, or a highly compensated employee. Now, I do talk to a lot of real estate investors who run their real estate investing business through, say, an S Corp or an LLC. So you will want to keep in mind that if that business entity, however it's incorporated, perhaps it owns a property, your retirement account cannot purchase it from that company, because if you're a majority shareholder or you're an officer or director, then it would violate this rule. So just some things to think about when you are thinking about what transactions you might engage in. Now, we do, for each of our clients, set up a particular structure for your retirement account investing. We use an LLC structure. It is a very specialized LLC. It's not a generic business one. Its operating agreement and articles of incorporation are written so that they can be used by a retirement account. So it's a very specific type of LLC that we create. We create this in the state of your choice. So when you are setting up an account and we are organizing your LLC structure, you can talk with our operations department to determine what state might work best for the types of investing that you want to do. The reason that we use this structure, there are a number of reasons. One is that it gives you a great deal of flexibility when you are structuring transactions. So you may have a transaction where you want to use a loan, you want to use leverage. You might have multiple parties to a transaction. And I'm actually going to talk to you in a moment about how you can, within the rules, partner with otherwise disqualified persons. So using this LLC structure gives you a lot of flexibility in doing complex transactions. It does also provide an additional layer of asset protection. It is a limited liability company. And I think one of the best features of this is it does give you checkbook control over your retirement funds so that you can quickly, immediately respond to a good investment opportunity. Now, you'll notice that I have checkbook control in quotes. And I have that there because we don't actually give our clients the checkbook for their retirement account. Rather, we have our clients send the documentation for the investment to our office, fax, email, however. Our client services department reviews those documents immediately. If they have any questions, they'll get in touch with you immediately. Otherwise, they can same day or next business day, depending on the time of day they receive the documents, fund that transaction. So basically, you have our expert staff looking over your transaction to make sure that you're not going to violate any of those prohibited rules, those rules that can get you in trouble. And at the same time, we can move real quickly to fund your transactions and get the money to the seller. So I call this protected checkbook control. That way you don't have to be the expert and you don't have to kind of put yourself out there on the line writing a check and maybe making a mistake and doing a prohibited transaction. You do want to be careful about those. The IRS is particular about looking into the transactions, and the penalties for engaging in a prohibited transaction can be severe, up to forfeiting your retirement account and it all becoming immediately a taxable account to you. So it is good that we have experts that can look over your transactions, but at the same time, we can get those funds to the seller quickly and get you that investment in your account. Using the LLC structure also simplifies asset titling. If you want to purchase a piece of real estate, you can actually go to the closing of that purchase, and you can sign the closing documents on behalf of your LLC retirement account because you are the investment manager when we set up the LLC structure. So you don't have to send the closing documents to our office where they might sit on somebody's desk. I've actually heard from somebody who worked with another company that happened. He had to send the closing documents, and the person who was to review and sign them was on vacation, and so it caused a significant delay. So that will not happen with the structure that we use. You can go to closing, you can sign on behalf of your retirement account. Another benefit of using our LLC structure is the ease of pooling or partnering with other funding sources to co-own an investment. So your retirement account might have insufficient funds to wholly purchase something, but you can partner with other sources of funds. So let's just think about this for a moment and look at our structure for your account. So this is a schematic that shows how the structure would work. On the upper left, you'll see current custodian. So this would be where you currently have your account. And let's say you decide you wanted to open an account with STC. You would complete documents with us that would direct your custodian to transfer or roll over the funds to our self-directed custodian. While that is in process, our operating department will be creating the LLC in the state of your choice that is going to become the investing vehicle for your retirement account. Once the LLC is set up and the monies are received at our custodian, then your funds will move to the LLC, to a bank account that your LLC has access to, and the ownership interest of the LLC will be held by the custodian. And now you're ready to begin investing. Now here you see in this example, your retirement account owns investment 1 and investment 2 completely. Your retirement account is the sole owner. However, investment 3 has 4 owners. Your retirement account is just one of the 4. And you'll see that the other owners are comprised of your father, your daughter, and some of your personal money. Now, I just told you on a couple of screens ago that there were disqualified persons, you, your ascendants, and your descendants, and that's who these three people are. And they are disqualified. However, if the transaction is structured properly, and if you co-invest at the inception of the purchase transaction, then this is a viable, allowable investment. In essence, what's happening is your father, your daughter, your personal money, and your retirement account are all purchasing from the seller. So none of you is involved with each other per se. So you can co-own something with personal funds or your spouse's IRA, as long as it's structured properly and you co-invest at the inception of the purchase transaction. So this is something that our client services department is adept at helping our clients with. So we can help you make sure that you have this all structured properly if this is the type of investment you want to do. I will add something here, and because we definitely do have clients that do this type of a transaction. They co-invest with otherwise disqualified persons. If you, let's just say, for example, it's a rental property. If you determine that you need to put a new roof on this property, then all 4 parties to the transaction do need to contribute their portion of the cost for that new roof. So there are things that do need to be maintained in this relationship to continue this as a viable transaction. But we certainly have clients that do these kinds of transactions, and it makes possible more transactions for them. Now, STC is a full-service, self-directed retirement plan administrator. That is all we do. And our approach is that we set up the retirement account LLC structure that I just described. We offer you that protected checkbook control. We have CPAs and attorneys available to answer any technical questions. We have a wonderful client services department that's available to give you unlimited guidance on transaction compliance, so you do not need to be an expert in any of the IRS rules. We will handle all of the back office support. There is a lot of administration that does need to be fulfilled for a retirement account. Books and records need to be maintained. An annual evaluation needs to be made. A report sent to the IRS. So we will handle all of that administrative support for you. We do offer you detailed financial statements. So you will have an online account that you can go and see how your account is. We obviously we let you know when we've received monies into your account or when an expense has been paid, and so you can see all of those detailed transactions. We supervise the regulatory reporting that's required, and we oversee the annual valuation. So our function, as we see it, is to provide you all of the administrative and transactional guidance you need so that you can spend your time finding the best investments for your retirement account. So that is our goal in helping you. Now I am going to open the floor for Q&A. I did receive a number of questions in advance, so I will pull those out. If you have a question, please do type that in the question box. You just click the arrow next to the word questions and a little window will open up and you can type in that and then I'll be able to see that. I will also put out some information for you while I'm pulling out those questions. You may know that you want to open a self-directed account, or you might have clients or colleagues who would be interested in self-direction, or you may just need more information. So if any of those is the case, please do check out our website at stcira.com. You can call our corporate office. The number is on your screen. And you can contact me directly via email at jknight@stcira.com. So please do, if things come up after I finish the webinar as well, please feel free to contact us. Okay, so back to the questions that I received, and let me open up my question box. Be just a moment here. Okay. I've had a couple of questions, so I'll kind of summarize these and just answer them in total about the difference between a rollover and a transfer. And this is kind of interesting terminology, but the term rollover, moving funds between an account you have and maybe to an account with us, the term rollover is used whenever the account holder moves money between two different kinds of retirement plans. So let's say you retire from a company and you had participated in the 401k, then you may want to move those monies into a plan that you qualify for. That would be moving it into a traditional IRA or SEP IRA, a plan that you currently qualify. So that's considered a rollover. Now there is also two different kinds of rollovers. I've had people ask me, so what's the difference between a direct rollover and an indirect rollover? So a direct rollover is when the funds move directly from your current, say, 401k administrator directly to our custodian. So that you don't receive any money. It goes direct from one custodian to another custodian. But there is something called an indirect rollover, and it's sometimes also called a 60-day rollover. And this is when you as the account holder actually take possession of the funds before they get moved into a new plan. And generally, you certainly can do that. Generally, you have 60 days to make a deposit into another account and complete that rollover, or the IRS can tax those funds. So you do want to be cautious about doing an indirect rollover. If you're younger than 59 and a half and you don't move the money into another account, you could also face a 10% early withdrawal penalty. So you just want to keep those things in mind. The other thing you do need to know is the IRS allows only one indirect rollover each year. So only one time per year can you receive that money and then put it into another account. That was a rule change a few years back. So something else to think about. So if you have any more questions about direct and indirect and 60-day rollover, just pop me an email and I can help you with that. I got another interesting question, and this is for someone who's older. Can an individual over age 72 convert her traditional IRA to a Roth IRA, even if she's no longer working? So you can convert traditional funds to Roth funds. When you do that, you will have to pay taxes on that conversion because obviously you didn't pay taxes on contributions into a traditional account. So there is a tax consequence of doing that. But yes, the IRA owner is not required to have earned income in order to be eligible to convert. However, because this person is RMD age, they're required to take their RMD required minimum distribution before the funds can be converted. So it's something you need to talk with your tax advisor about. But yes, you can still convert even if you're not earning income and can't make a contribution. Okay. Is there a minimum age to open and contribute to an IRA? No, there is no IRS minimum age restriction for an individual to open and contribute, but the individual does need to have taxable compensation to base the IRA contribution on. So, and you do want to keep in mind that an IRA sponsor might have a minimum age, just as their corporate policy. So that's just something to keep in mind. But there is no minimum age, but you can only make a contribution from earned income. So you do have to have earned income. Okay, some other questions that, okay, let me look here. All right. Does a loan I make from my IRA have to be secured? No, the IRS does not require you to have the loan secured. However, you will want to keep in mind that your IRA investment is more protected if it's secured. You will also want to be sure, in addition to having any collateral listed on the note, that there is a lien recorded on that property as well. So you do need to make sure those things happen if you do want collateral security on your loan. Are custodial groups such as yourself restricted to handling accounts within a limited region, or do you handle accounts nationwide? We do handle accounts nationwide, and as I mentioned, you can also choose any state for the incorporation of your IRA LLC, and our operations department will be happy to discuss your options with you when you're ready to set up your account. Do I have to pay taxes on the income that is generated by my IRA? Normally, no, at least not until you begin taking distributions and they're included in your taxable income. There are a few exceptions. If you use a non-recourse loan, like I mentioned earlier, to purchase a property, then you may have to pay UDFI, unrelated debt financed income. It is a subset of UBIT, unrelated business income tax, and you may have to pay that on a portion of the income, and that is based on the percentage of the property value that is debt financed. So there are also some other cases where taxes might come into play if you're investing in an active operating business. Those are pretty rare, and you can always talk with our client services department to determine if an investment you're thinking of might trigger one of those taxes. Okay, if I want to purchase a bank-owned house, they often require verification of funds. How would I verify funds that are in my self-directed IRA? Our client services department can supply you with a proof of funds letter, and we ask that you call or send us an email, and we can prepare that letter and email it to you, and we can get that to you, 24-hour turnaround, business hours. What we would ask of you is that you tell us the amount of funds up to the full value of your account that you want listed in the letter. It can't be more than what you have available, but it can be less. And you might want the seller, you might have a limit on the amount that you want to pay for a property. So you might want the seller to know what your limit is, not all the funds you have available. So we can provide you with that proof of funds letter up to the full value of your account. Okay. I am considering a Roth conversion. Should I do that prior to transferring or rolling the funds over to you? If so, are there additional fees associated with the conversion? You can do the conversion either at your current custodian. I mean, we don't know what their terms or rules are, or with us. If you choose to convert through STC, we will supply the conversion documents with your initial paperwork packet. We can do that, and we'll provide you with as much assistance as we can with that conversion, keep you posted. If you do choose to do the conversion with us, there are no additional fees for doing that. Can I decide to roll over a portion of my 401k corporate to a self-directed retirement account? For example, I have $50,000 in my 401k. Can I take out $25,000 and put it in a self-directed account? Okay, I can't give you a definitive answer on this. If you're still employed by the company that sponsors the 401k plan, probably not, but there are exceptions. On some occasions, they might allow you to roll over part while you're still employed, especially if you brought plans from a previous 401k into their plan, or if you've reached a certain age. Sometimes plan documents permit that. So as I mentioned earlier, you will need to go to your plan administrator with your company and see what they permit you to do. I would like to tell my CPA more about your services. Do you work with these types of individuals to set up accounts? Well, we certainly are happy to help your CPA understand, and if there's something we can do, I would suggest that you call our corporate office and talk with our COO, Nick Hirsch, and he can give you more guidance on, he'd be happy to talk with your CPA to help. Sometimes CPAs aren't real familiar with retirement account investing or self-directed retirement account investing, so we can certainly help them understand if there are some nuances that might pertain to your account with us. Okay, I'm just looking to see if I have any different. Okay, looks like I have a different question here. I want to start investing in real estate, but I don't have enough in my IRA to buy a property outright. Do I have other options? Well, yes, as I mentioned, you can partner with another individual that has funds. So you could be co-owners, and again, they can even be disqualified parties if it's done properly at the inception of that transaction. You can also consider borrowing funds. As I mentioned, you could get a non-recourse loan And, if neither of those works, it's not quite the same, but you could also make a loan to a real estate investor and have that loan secured by the property. So it's secured by real estate. If there was a default, you could foreclose on that property. So those are a couple of options that are available to you. Okay. If you have a rental property in your account, who does the renter send their rent check to? Well, that really depends on whether or not you're using a property manager. We do highly recommend that you use a property manager because you do need to maintain, distance from your retirement account. Remember, you're a disqualified person to your retirement account. So when you're using a property manager, the renter would make the check payable to them, and then they would take their portion and they would send the remainder to your IRA LLC. If you're not using a property manager, then the checks would be made payable to your IRA LLC and mailed to our office, or they could be mailed directly to you. And then you would just have to turn around and mail them to us. Just want to be sure they're not made payable to you personally, because that can be a problem. So you do want to be careful about that. Okay, it looks like I have one more question here. If I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with IRA funds? Yes, you can. You can open it with any company that you choose. You do need to make sure that it is opened as a business account and that it is opened in the name of your IRA LLC. So our client services department can help you with that. And we do request that you send us copies of your monthly statements because we need to review those and ensure that you're not making any deposits directly into that account or taking any withdrawals directly from that account, because they do need to go through your IRA LLC, because it is your retirement account, not you personally. So you can do that, and we can help you facilitate that. Well, I want to thank you so much for joining me this evening. I do hope that you will consider joining me next month for our educational webinar. Please do get in touch. Our website has a great deal of information, stcira.com. You can call our corporate office if you have questions, and you can also contact me directly at jknight@stcira.com. Thank you. Have a good evening.